Hello everyone, I'm very excited to be interviewing Bob Coleman, who goes by the name Profits Plus on the X platform. He owns Idaho Armored Vaults and studies valuable metals for a living. Please accept my thanks for being here today, Bob. You made a challenge about playing games with people. I wanted to talk about it with some people in the community, and I'm grateful that you agreed to come here to do that. Before we start, I'd like to give you, especially those of you who are new to this channel, a general idea of what I think deception means. We talked about how it could be seen as either trickery or real management before we came on. After this, we'll talk about that. It seems like two different things to me, though. I think that manipulation is when prices are taken care of or pushed up or down, like what happened with JP Morgan. And the case where they were punished with the precious metals dealing desk is well known. They were all punished for it. I talked about it a lot on my show when that case was still going on. But that was lies told to get what you wanted. It's called spoofing. The market when people change the prices of gold, silver, platinum, and palladium up or down for their own personal gain so that they can make money with high-frequency trade. So that's what has been proven and written down. Then there's the idea of a plot. My mind is becoming more open to it than ever before. This is why I wanted to talk to you about price suppression or manipulating prices to the downside. A lot of people think that the big bullion banks are doing this. I just recently learned that most of the money that is managed in those ETFs is by those big bullion banks. JP Morgan is the biggest owner, but there are others as well. The high gold to silver ratio is one sign of this. They want to do this because they know how useful silver is for the military, the industrial complex, and many other things. It's the best thing for them. This means that they are working together to keep the price of silver low for a reason other than their own benefit. I'm becoming more open to it, but I've been against it for years because I haven't seen strong proof of it. That's why I wanted to talk to you about it, along with how the silver markets are run. Once more, thank you. That's how I introduced it to you. I'll let you do it. What do you think about that? Yes. Thank you for having me on. Also, I definitely wanted to make it clear that anyone who wants to talk about this is welcome. It seems like an important subject. The retail promoter-dealer industry uses this basic sales technique a lot to get people to worry about the system and then get them off the couch to buy metals. It's a very broad subject when it comes to influence and management manipulation. I think this is more like when you're talking about the price action of, say, these sell-offs that happen at 2 a.m. We used to see these a lot in the early 2000s, where there's a flood of selling or a price spike. It could go either way. A lot of people were saying, wait a minute, that's a big bullion bank coming in, wiping out the market and trying to artificially drive the price down for some kind of stated goal. Whether that goal was to show that the dollar was stronger than the metals or to boost confidence in the system or something else. That story isn't true because the price of gold has gone up 10 times since 2000. For this management argument, yes, you can compare gold to the amount of money in circulation, debt, and other things. There is no doubt that gold prices could go up because the matrix and all the estimates are very, very off right now. In the world of rare metals, there is, however, someone who is like a big brother, who is always biting the bullet. Over time, I think they've done a terrible job of trying to control the markets. The problem we see most of the time is that our business could use a lot more education. I'd like to know more about these terms, because when you talked about the JP Morgan case, for example, there were several instances of what you called spoofing from 2008 to 2016, in which someone tried to fake a bid or an offer to move the price in a way that would allow them to make a deal. People who make a bid or an offer but don't plan to follow through with it are included in that part of the transaction. That is faking, yes. In that case, someone was definitely charged, and they were found guilty. What is hard to understand is the main idea that someone or a group of banks manipulated the price of silver over a certain amount of time. That's a lot harder to explain. When it comes to intent, which is the hardest thing to prove in court when you're talking about manipulation, it's rougher to describe. Just like you said, it's one thing to fake the price, and it's another thing to fake it either up or down. That's pretty easy to understand. And so on. You look at price orders, price order books, and other things. The CFTC can get all of this information. They can use it to look through price books, computer logs, and other things to try to figure out what people were trying to do. That's not at all the same story. Does that help a little? Yes. And I think that's the point. The aim is to hide. To clarify, there are two situations. One is when the spoofing was done for personal gain, and the other is when the big bullion banks wanted to hide something. This is harder to describe and figure out. But there were a lot of people in the room, and I fought it for a long time. I have a more open mind now, but I still haven't seen proof of censorship. And I wanted to know what you thought about that, about whether prices are really being slowed down by a group of companies or a plot between the big banks. Yes, I think you need to take a step back so that your audience can appreciate that. In the world of precious metals, you deal with more than just physical metals. You deal with options, futures, structured products, forward contracts, swaps, and a whole other set of business terms. I mean, it's a really big business. Lots of different players are doing different things at the same time, which is changing the price movement. Furthermore, in New York, we have the COMEX, which is our futures market. People who trade on that market usually use it as a way to protect their losses, as it is a seller's market. For instance, if a bank, and just so your audience knows, the biggest buyers of metal, especially at the beginning of this year, were banks. A huge amount of gold and silver was bought by them. So they put that metal on the market and sold futures contracts against that physical or inventory position that they already had. But to get back to what the COMEX is for, the futures markets have traditionally been used to protect against price risk. For example, farmers who want to protect their corn crop or another type of product use these markets to try to balance out price risk. London, which is known as the physical metals capital of the world, deals with spot prices or actual metals most of the time. Players like these buy the real and then short the futures contract in New York. This locks them into what is called a certain kind of spread. This difference is known as the trade for physical. There is a gap between the spot price and the higher futures price. This is the difference. In this case, the futures price is greater than the spot price. That spread makes them money. The trouble is that it tends to bring more sellers into the market, and most people may not know that these are sellers who have a real-world location. And this is something that the community of retail dealers who try to make the manipulation case doesn't really do a good job of explaining. If they looked into it a bit more, they'd see that a lot of the time they're trading on leverage and the spread. If you don't trade, you might be in a long-term position where prices are going in a certain way. The only thing they want to do is lock in and keep getting pennies on the dollar over and over again. Another thing you can find is ETFs in London, for example. ETFs have really grown into a huge business, especially in the commodities world. A few of the largest ETFs are SLV and GLD. So, here's how ETFs work. They hire approved participants, and those authorized participants give the ETFs cash. They will buy metal from the ETF, give it back to them in the form of shares, and then sell those shares on the market. They can also buy shares on the open market and then trade those shares in for the metal. As part of their job to provide liquidity to the ETF, they do this every day by moving shares and metal back and forth between the ETF. You and I can sell SLV shares into the market when we want to. The market maker can then say, okay, if those shares are at a discount, I'll buy those shares. NAV is less than the price of the shares. I'll buy the shares and give them to the fund. That fund will then give me metal back, so I can make money by buying shares that are cheaper than the metal they are backed by and then getting the metal back. After that, they make money from a spread or a profit. Most people don't understand that when people buy in an ETF, they think the ETF is the product. In the world of ETFs, the customer is the product, so to speak. Market makers get paid when money comes and goes from these ETFs. One more thing, that's just a tiny part of the world of valuable metals. With the futures markets and the tariff problem earlier this year, you can enter into forward contracts and spot forwards. As you may know, one of the main reasons there was so much inventory coming into the COMEX earlier this year was because some foreign investors were hedging their physical position in London by buying bars that were actually Canadian. In the beginning of the year, Trump threatened a tax saying, listen, if you bring those bars into the country, we're going to tariff you possibly 25% or 50%, whatever the number is. All of a sudden, you can't hedge that tax. And if you wanted to settle that futures contract, that short position you had against your underlying position, let's say you had $1 million in metal, you'd have to pay another $200,000 just to get it into the country. This would wipe out any profit you made and leave you with a huge loss. So, people rushed to bring any metal they had into the US before the deadline, when taxes might have started to happen. Again, that was a lot of banks buying a lot of metal, mostly from refiners in the US, but they brought it in huge waves. Again, that's not talked about in the world of store dealers, promoters, or social media. You should hear them. China and India are buying all this metal. And they are. They buy a lot of metal. The bank part, which has been one of the biggest sellers, especially in the US, was left out. You can see that retail activity in rare metals has dropped sharply over the past few years if you look at it this year and last year. From the beginning of the summer until maybe the end, small buyers have been selling metal in waves, saying, hey, listen, I'm happy with the price where it is, or I'm afraid it's going to crash back down. These people believe this story about manipulation, so they sell and never come back, even though prices are going up. In a way, the story that store dealers have been telling the public is now backfiring because it made people so scared that the price is going to drop again. They want to get the gain as quickly as possible. Yes, it's hard. That being said, I want to keep an open mind about it, because I keep hearing that they are all shorting the market. They are selling it short. Of course, I talked about this in a video I made about a month or so ago, and those positions have now changed to the long. That change is now beginning to show. On the other hand, one of their main points is that they are all shorting the silver market. That's the reason the price is so low. Also, the amount of gold to silver is very high. You did say, though, that the silver market is very complicated and has many moving parts. You already said that you look at these overnight, high-frequency trades, these smackdowns, and prices are at 2 a.m. And on Friday Smackdown, there's a former user named Mr. Slammy. He then said, all right, Mr. Slammy is coming back. Today is Friday. We're all set to do it. This is what they're talking about. Selling together. As you know, we're mostly talking about it in the paper markets. You know, I like to think of ETFs as not buying silver, but rather having a stake in the price of silver and buying the real thing. For now, I'll leave you with that as far as this subject goes. You say that they are organized selling and shorting the market to keep the price low. What do you say to that? When the futures markets aren't very busy at night, you need to keep in mind that Asia is dealing during the day at that time. For this reason, you usually see Asian sellers come in and take out the bid. Please note that this is not always the case. You should also keep in mind that there are a lot of orders stacked in the market book, the futures book, or the clearing member book. So they have what they call stop orders, which are used all the time. Let's say you own gold that is worth $3,000 an ounce. And as a trader, you have to keep in mind that when you look at the futures price, you're seeing a product that is being sold with borrowed money. There is no leverage on this protection. It's not like when you and I buy 100 ounces of silver with cash and don't care if the price goes up or down 50 cents. For example, when you use 10-to-1 leverage, you do care. Yes, that 50 cents can mean a lot more when it comes to what they call a margin call. So, when someone sells something on the market, it could be anyone. It could be anyone in the market. It could be an organization that wants to build a position that goes in and starts selling the market down. They know that if they hit enough sell stops, they'll cause a mini avalanche of selling, which will allow them to sit on the bid and start buying, which will help them build their position. In fact, we saw something similar happen in April when the price of silver dropped quickly from $35 or $34 to $28.50. Some very well-known investors actually got into the market and bought during that big drop. The people who watch the markets may also be market makers from time to time. They see how easy it would be to make order books for their customers who want to use them. They can make that instability happen so that they can work on things like building that position for their client. For a regular investor, that might not seem like trickery. That's kind of unfair. But that's pretty much how Wall Street works. It has been that way ever since the market opened, which was a very long time ago. Stock operators and other people like them used to do this in the 1920s. They would move the market up or down. That's part of the reason why I think the whole system is set up. It's not just the metals markets. It's clear that people are angry because you only have to look at the stock market, the currency market, or the treasury market. Take a look at the S&P 500 from 2020 as an example. From 2000 or 1971 to now. In terms of relative success, gold has done better than the S&P 500, even when dividends are taken into account. This is because most of the companies that were in the S&P 500 in 1971 are no longer in the index. Most of them may no longer be in business or have been bought out by another company. As you may know, the S&P 500 is a controlled index, which means that the bad stocks are taken out and the good ones added all the time. Because the index is always changing, this is one reason why fund managers have done worse than the index over time. Well, that's just another way that the market works. Some people might call that trickery, but that's just how it is. What you say is very true. Almost every market is influenced. I believe that the Federal Reserve is one of the biggest manipulators. I once made a film in which Janet Yellen, the former head of the Federal Reserve, said one word that caused gold and silver prices to go through the roof. There is a lot of psychology at play in the markets, and that's really all it is. Politics and psychology are what they are, and the people in power are in charge of them all. Also, I'd like to talk about something you mentioned earlier, as a YouTube program about precious metals, Summit Metals, a bullion dealer, sponsors me, and I want to be very careful. In fact, I'm not allowed to do hype because of my deal.